Hello and welcome to today's webinar on IAS 12, dealing with the accounting for income tax. In today's webinar, we will be looking at the requirements of IAS 12 from the perspective of current as well as deferred taxes, as well as looking at the January 2016 amendments to the standard, which explained some of the accounting requirements relating to the recognition of deferred tax assets. The standard deals with income taxes based on taxable profits. In other words, if an amount is payable to government, which is based on taxable income, regardless of how that taxable income is calculated, it is accounted for in terms of IAS 12, and the standard deals with both domestic and foreign income taxes. It's worth noting that other payments to governments that are not based on taxable income are instead dealt with in terms of IFRIC 21, which deals with the accounting for levies. The standard excludes any amounts arising from government assistance in the form of government grants and investment credits. However, it does deal with any resultant temporary differences that might arise from such transactions. The standard deals firstly with current taxes, and to be honest, the accounting for current tax is relatively straightforward. Current tax is based on the taxable profit for the current reporting period, so an entity will calculate whatever it owes to government as a result of the income and expenses for the year of assessment for a particular period. Multiply that taxable income by the respective tax rate, and that will give the entity the amount of its tax liability for the year. If the entity has prepaid any portion of the tax liability in the form of provisional payments, it will only reflect the remaining portion to be paid as a liability. In some cases, if the provisional payments throughout the year have exceeded the total tax liability for the year, then any amount to be refunded will likewise be reflected as an asset. And that is really as complicated as current taxes get. The focus of IAS 12 is clearly on deferred taxes. The deferred tax calculation looks something like this, and we will revisit this calculation a number of times over the rest of this webinar. But in essence, what you see on the screen in front of you is referred to as the balance sheet liability method for calculating deferred tax, which basically says that the difference between an asset or liability's carrying amount and that asset or liability's tax base gives rise to what is known as a temporary difference. That temporary difference is multiplied by the applicable tax rate, which then gives us the amount of deferred tax relating to the asset or liability. What this balance sheet liability method is giving us is essentially the tax consequences of the assets and liabilities at any particular point in time. So an entity's balance sheet is made up of the various assets and liabilities. The realization of those assets and liabilities, dealing for example now with an asset, as an entity realizes the carrying amount of an asset, there will presumably be tax consequences from that realization, either in the form of sales from selling the asset, or perhaps revenue that's generated from using the asset. Regardless of how that future economic benefit materializes, the tax consequences relating to that asset have to be recognized. And that is what this formula is giving us. Just a couple of key definitions to make the explanation of IAS 12 a little bit easier. Taxable profit or tax loss is the profit or loss for the period that's determined in accordance with the rules established by the tax authorities. Now, governments around the world have their own tax rules depending on which jurisdiction an entity is dealing with, and so the taxable profit will be determined with reference to each different jurisdiction that the entity is subject to. Current tax is the amount of income tax payable or recoverable in respect of the entity's taxable profit or loss for the period. The tax expense or tax income is the aggregate amount included in the determination of profit or loss for the period in respect of current tax and deferred tax. So the tax amount in the statement of profit or loss and other comprehensive income includes both the current and deferred tax movements for the current period. Deferred tax liabilities are the amounts of income taxes payable in future periods in respect of taxable temporary differences, and deferred tax assets, in contrast, are the amounts of income taxes recoverable in future periods in respect of deductible temporary differences, carry forward of unused tax differences, and the carry forward of unused tax credits. A temporary difference is the difference between the carrying amount of the asset or liability and its tax base. So taxable temporary differences then arise when the recovery or realization of the asset or liability in future amounts will result in higher taxable profits for purposes of calculating an entity's tax liability in future periods. Whereas a deductible temporary difference is a temporary difference that results in a future deduction against taxable income in future periods. The tax base of an asset is the amount that is attributed to the asset for tax purposes. But it's quite important that we understand the next section. Essentially, the tax base refers to the amount of future deductions that are available in respect of that particular asset. So when the carrying amount of the asset is realized in future periods, the amount of any deductions against the future taxable income that relate to the recovery of that asset is what we refer to as the tax base. The standard does make a provision for a situation where the recovery of the asset might not result in taxable or not have tax consequences. And so it says if those economic benefits are not taxable, then for purposes of deferred tax, it is assumed that the tax base of the asset equals its carrying amount. This is one of the most important definitions that we need to understand, this and the tax base of the liability, because this is what the calculation of deferred tax hinges upon. Let's see if we understand the definition of a tax base of an asset by looking at a couple of examples. In our first example, we have a machine which cost 100 originally. For tax purposes, depreciation of 30 has already been deducted in the current and prior periods, and the remaining cost will be deductible in future periods, either as depreciation or through a deduction on disposal. Revenue generated by using the machine is taxable. Any gain on disposal of the machine will be taxable, and any loss on disposal will be deductible for tax purposes. Now remember, the definition of the tax base of an asset is the amount of future deductions that are available to the entity as it recovers the carrying amount of the asset. So if the machine originally cost 100, on day one, assuming all of the cost would have been deductible for tax purposes in future periods, the total tax base on day one would be the original cost of the asset. At this point, we've already deducted 30 in current and prior periods, which means that the remaining deductions in respect of this particular asset are the remaining 70, in other words, the unclaimed tax deductions in respect of this machine. In our next example, we have interest receivable with a carrying amount of 100. The related interest revenue will be taxed on a cash basis. Once again, the definition of a tax base is the amount of future deductions. When the entity recovers this 100, what will be the amount of future deductions that it can claim as it recovers this carrying amount? There's no indication of any deduction available for interest receivable, and we also know that, based on the fact pattern, that the interest will be taxable when the entity collects the money. Therefore, the tax base is null, which gives rise, when we go back to the formula for calculating the deferred tax on this, the carrying amount of 100 less the tax base of 0 gives rise to a temporary difference of 100, which in this case is a taxable temporary difference, because essentially what we're saying is when the entity collects this money, it will have to pay tax of 100 in future, or tax on 100 in future. For our next example, trade receivables have a carrying amount of 100. The related revenue has already been included in taxable profit. Now, those of you that remember the definition of the tax base of an asset from a couple of slides back would recall that I said if the future economic benefits are not taxable, IAS 12 assumes that the tax base equals the carrying amount. In this case, the entity has already paid tax when they first accrued for this amount on their balance sheet. This means that the future collection of the 100 when they collect the money owing to them will have no tax consequences, which means there is a zero tax effect as in respect of this particular asset. Therefore, the tax base is 100. And if the carrying amount of the asset is 100, the tax base is 100, there is zero temporary difference. Dividends receivable from a subsidiary have a carrying amount of 100. The dividends are not taxable. Once again, if the asset will not have any future tax implications, in other words, there will be no tax payable as they collect the money, there is a tax base which equals the carrying amount, and in this case the tax base equals 100. A loan receivable has a carrying amount of 100. The repayment of the loan will have no tax consequences, and similar to the previous two examples, the tax base in this scenario equals 100. The definition of the tax base of a liability is the carrying amount of the asset less any amount that will be deductible for tax purposes in respect of that liability in future periods. So what we're saying here is a liability is something that has to be settled in future, presumably by an outflow of economic benefits. If the entity will be able to claim a deduction in respect of that outflow of future economic benefits in future periods, then presumably there will be a tax base at play. In this case, it's important that we remember that the tax base of the liability is always assessed with reference to the carrying amount. So there's a bit of a calculation that has to be done when one is trying to calculate the tax base of a liability. It's always what is the carrying amount of the liability less any future deductions available in future periods. If the liability arises because of revenue that has been received in advance, the resulting liability's tax base will also likely be, similarly be, the carrying amount less any amount of revenue that will not be taxable in future periods. Let's see if we understand this with a couple of examples. In our first example, we have current liabilities which include accrued expenses with a carrying amount of 100. The related expense will be deducted for tax purposes on a cash basis. For ease of reference, the tax base of a liability is the carrying amount less the amount of future deductions. In this scenario, the carrying amount is 100. We will get deductions when we settle the liability. Therefore, the carrying amount of 100 less the future deductions of 100 gives us a tax base of 0. Taking this into the definition of, or into the formula for deferred tax, if we compare the carrying amount of 100 to the tax base of 0, in essence what this liability represents is future deductions for the entity, which gives rise to a deductible temporary difference. In our next example, we have current liabilities that include interest revenue received in advance with a carrying amount of 100. The related interest revenue was taxed on a cash basis. In other words, we already paid tax when we received the money. In this case, the definition of the tax base of income received in advance is the carrying amount of the income received in advance less any amounts that will not be taxable in future periods. So if the carrying amount is 100, we've already paid tax on 100, therefore the tax base is the 100 carrying amount less the 100 that has already been taxed and therefore will not be taxable in future, which gives us a tax base of 0. The next example refers to current liabilities which include accrued expenses with a carrying amount of 100. The related expense has already been deducted for tax purposes. So here we've got a scenario where we already claimed a deduction even though the amount has not yet been settled. The formula still stands. The tax base is the carrying amount of 100 less the amount of future deductions of 0, which gives us a tax base of 100. But taking this tax base of 100 into the deferred tax formula, we have the carrying amount of 100, the tax base of 100, which means that there's a 0 temporary difference. And this essentially means that this item is tax neutral on the basis that we've already dealt with the tax consequences, and the settlement of this liability will have no further tax consequences. Current liabilities include accrued fines and penalties with a carrying amount of 100. Fines and penalties are not deductible for tax purposes. So we've got a liability that has to be settled, but there will be no future deductions. Once again, the formula stands. 100 minus 0 future deductions gives rise to a tax base of 100. And here again, because the tax base equals the carrying amount, this item is also tax neutral. Our last example includes a loan payable with a carrying amount of 100. The repayment of the loan will have no tax consequences. If there are no tax consequences, there are likewise no future tax deductions, and therefore 100 minus 0 gives us the tax base of 100. Sometimes an item might have a tax base, but it might not be recognized as an asset or liability in the balance sheet. For example, under IAS 38, research costs on an internal research and development project are expensed when calculating accounting profit or loss, but may not be permitted as a deduction for tax purposes until a later period. In such instances, you would have a carrying amount of 0, but a future deduction available to you, which likewise gives rise to a temporary difference. Putting this back into our formula for deferred tax, the carrying amount of 0 less the amount of future deductions in respect of these research costs gives rise to a deductible temporary difference, which would then ultimately be recognized as a deferred tax asset, as we'll explain in just a moment. When it comes to calculating deferred tax in consolidated financial statements, it's important to remember that the same basic principle applies. One compares the temporary difference, or one determines the temporary difference by comparing the carrying amount of the assets and liabilities on a consolidated basis with the appropriate tax base. Now, some jurisdictions might permit a consolidated tax return to be submitted for an entire group. And if that's the case, then you would consider the consolidated carrying amounts against the consolidated tax bases for that particular consolidated tax return. In jurisdictions where each individual entity within the group is considered to be a separate tax-paying entity, what you'll probably find is that the tax base is carried upwards into the consolidated accounts from each individual entity. But you might find that the carrying amount changes in the consolidated financial statements as compared to the separate financial statements of the respective entity, particularly where adjustments are made, for example, to align accounting policies between different entities in the different group, as well as to take into account the differences in carrying amounts that arise from applying business combination accounting at the initial recognition of a subsidiary that's been accounted for in terms of IFRS 3, business combinations. We've already seen that a taxable temporary difference refers to a situation where the entity has a higher tax liability in future periods as a result of the recovery of the assets and liabilities that it presently has on its balance sheet. And IAS 12 requires all taxable temporary differences to be recognized as deferred tax liabilities, with certain exceptions. The first relates to the initial recognition of goodwill, And the second is a little bit more general, and that refers to a scenario where a taxable temporary difference arises from the initial recognition of an asset or liability in a transaction which is not a business combination and at the time of the transaction has no impact on accounting profit or tax profit or loss. To give an example of such a scenario, consider an asset that is acquired for which there are no taxable deductions available. So, for example, a capital asset is acquired and the tax authorities do not permit any deductions relating to that asset for tax purposes. On day one, we have a cost of whatever the value of the asset was on day one, its carrying amount, and we have a tax base of nil because there are no future deductions available for the asset. As a result, we have a temporary difference that arises on initial recognition, and provided that is not a business combination, the standard essentially says do not recognize a deferred tax balance in respect of what is essentially a permanent difference. It is possible that such a scenario might arise where you've got a difference between the tax base of the asset and its carrying amount, but arising from a business combination. But because the standard, the exemption does not relate to business combinations, temporary differences arising from business combinations are recognized as deferred tax assets and liabilities. Similarly, IAS 12 also requires all deductible temporary differences to be recognized as deferred tax assets, but again, to the extent that the deferred tax asset does not arise from the initial recognition of an asset or liability in a transaction that is not a business combination, and at the time of the transaction there's no impact on accounting profit or taxable profit. However, IAS 12 does impose an additional restriction on the recognition of a deferred tax asset. And a deferred tax asset can only be recognized to the extent that it is probable that taxable profits will be available against which the deductible temporary difference can be utilized in future periods. We will revisit this again in a little bit more detail a little bit later on. Let's see if we understand the principles for recognition of deferred tax assets and liabilities. In our first example, we have an asset which cost 150 and has a carrying amount of 100. Cumulative depreciation for tax purposes is 90 and the tax rate is 25%. What deferred tax liability should be recognized? Now, when dealing with this sort of calculation, it's always good to go back to basics. We've already said that the tax base of the asset is the amount of future deductions available. So it's the original cost of 150 less the deductions that have already been claimed of 90, which gives us a current tax base of 60. The carrying amount is 100. Therefore, the formula for deferred tax, which says carrying amount less tax base, gives us a taxable temporary difference of 40. On the 40, we multiply that by 25%, the currently enacted tax rate, which gives us a deferred tax liability of 10. The journal entry to record this deferred tax will be a debit to deferred tax expense in profit or loss of 10 and a credit to deferred tax liability in the balance sheet of 10. In the next example, we have an entity which recognizes a liability of 100 for accrued product warranty costs. For tax purposes, the product warranty costs will not be deductible until the entity pays claims. Once again, the tax rate equals 25%. What deferred tax asset should be recognized? To remind you again, the tax base of a liability is the carrying amount of the liability less the amount of future deductions. In this case, we have future deductions of the full value of the liability, because we will only be able to claim the deduction when we actually settle the claims. Therefore, the tax base is null, the carrying amount is 100, our deductible temporary difference amounts to 100, and deferred tax on that would be 25. The journal entry to record it would be a debit to deferred tax asset on the balance sheet of 25, a credit to deferred tax income in profit or loss of 25. But remember, we are limited to recognizing a deferred tax asset only to the extent that we believe we'll be able to utilize that deferred tax asset. And we'll only be able to utilize a deferred tax asset if we've got taxable temporary differences in future periods, or if we believe we will have sufficient taxable profits against which we can claim these deductions. As we saw earlier, it is possible to have a temporary difference that arises even though there is no asset or liability on the balance sheet of the reporting entity. And IAS 12 requires a deferred tax asset to be recognized for the carry forward of any unused tax losses and tax credits to the extent that it is probable that there will be sufficient future taxable profit against which the unused tax losses and tax credits can be utilized. This can be difficult to estimate in practice, particularly where there's uncertainty as to the availability of tax planning opportunities, how an entity's budgeting and forecasting would show evidence of future taxable profits, and in circumstances where there's been a history of recent tax losses. For example, the standard specifically refers to a scenario where you've got a tax loss in either the current or the preceding reporting period. One would need convincing evidence that there would be sufficient future taxable profits before one would be permitted to recognize a deferred tax asset in respect of these tax losses. In addition, in jurisdictions where these tax losses might expire, there will be even more emphasis on the need to identify exactly when one expects to become profitable, because if the entity will only become profitable, say, after the assessed loss has expired, well then it wouldn't be appropriate to recognize any deferred tax balances, because it's unlikely that the entity would be able to benefit from such an assessed loss. If an entity has not recognized any deferred tax assets from unused tax losses, specifically because there's insufficient evidence to suggest that there will be future taxable profits, the entity would be required to annually reassess this to see whether there's any indication that estimates from previous periods might have changed. Insofar as measurement of deferred tax is concerned, we saw in our two examples that the tax rate was given to us. In practice, deferred tax would have to be measured at the tax rates that are expected to apply to the period when the asset is realized or liability is settled, based on substantially enacted tax rates as at the reporting date. In addition to that, it would also be necessary to identify how the entity plans to realize or settle the liability, particularly where there are different tax outcomes depending on whether the asset is used, for example, or sold. And to the extent that there are different tax rates and possibly even tax bases based on this outcome of use or sale, the deferred tax would have to be measured based on the entity's expectations. As an exception to the rule of having to assess each individual asset on a case-by-case basis, IAS 12 specifically refers to the recovery of non-depreciable assets that are carried at revalued amounts in terms of IAS 16. So this refers specifically to, for example, land that in terms of IAS 16 is measured using the revaluation model. Just as a brief reminder, land under IAS 16 is typically not depreciated because IAS 16 acknowledges the fact that it typically has an indefinite useful life. Because it is non-depreciable and because it is carried at a revalued amount, IAS 12 takes the view that the recovery of land can only be achieved through sale. And as a result, IAS 12 says that the measurement of deferred tax relating to such land must reflect the tax consequences of recovering the carrying amount through sale, regardless of the actual basis of measuring the carrying amount of that asset. Similarly, when it comes to investment property under IAS 40, there's a rebuttable presumption that is introduced that says that the deferred tax liability or asset that arises from the investment property measured using the fair value model is measured on the basis of the consequences of sale. In other words, regardless of the entity's intentions or expectations, the deferred tax implications of investment property at fair value will always consider the tax consequences from sale, and if there are different tax rates arising from that, those tax rates would be used. It is possible to rebut this presumption if the property is depreciable and it is the intention to consume substantially all of the economic benefits of the investment property over time rather than through sale. So if there is no evidence that the investment property will ever be sold, notice that it must be substantially all of the economic benefits through use as opposed through sale, then under those circumstances we would rebut this presumption. But if we rebut the presumption for investment property at fair value, then we're back at where we started, which says that the measurement of the deferred tax balances should reflect the tax consequences that would flow from the manner in which the entity expects at the end of the reporting period to recover or settle the carrying amount of those assets and liabilities that give rise to temporary differences. Now, specifically in respect of investment property, the implications of rebutting the presumption would result in having to consider the tax base of the land separately from the tax base of the building and calculating the deferred tax accordingly. Let's take a look at an example to see the implications of the distinction between recovery through use and recovery through sale. In this example, we have an asset with a carrying amount of 100 and a tax base of 60. A tax rate of 20% would apply if the asset was sold, and a tax rate of 30% would apply to any other income. What deferred tax asset or liability should be recognized depending on whether the asset is sold or used? Firstly, we have a temporary taxable difference of 40, which is the carrying amount of 100 less the tax base of 60. The deferred tax liability, if we were to consider the implications of sale, would be the temporary difference of 40 multiplied by the tax rate relating to sale, resulting in a tax liability of 8. And the tax liability through continued use would be at the higher tax rate of 30%. Although this simple example doesn't reflect it, it is also possible that the tax base could be different depending on whether the asset is sold or used. So just keep that in the back of your minds when it comes to calculating these deferred tax balances in practice, that one needs to consider all possible tax outcomes based on the entity's expectations for the asset and liability. For our next example, we have an item of property, plant and equipment with a cost of 100 and a carrying amount of 80, which is revalued to 150. Now remember that revaluations of property, plant and equipment are recognized in other comprehensive income in the revaluation reserve. Cumulative depreciation for tax purposes is 30 and the tax rate is 30%. If the asset is sold for more than cost, the cumulative tax depreciation of 30 will be included in taxable income, but sale proceeds in excess of cost will not be taxable. What deferred tax asset or liability should be recognized depending on whether the asset is sold or used? So for the first example, let's consider that the asset is used. We have a tax base of 70, which is the original cost of 100, less the 30 that's already been claimed for tax purposes. In other words, the future tax deductions. The temporary difference is the carrying amount of 150 less the tax base of 70, resulting in 80, on which we recognize deferred tax at 30%. And notice here that the deferred tax is recognized in other comprehensive income as opposed to profit or loss, the reason being that the revaluation was also recognized in other comprehensive income. So the recognition of the deferred tax follows wherever the accounting has been recognized. The accounting profit or loss has been recognized. If the intention is to sell the asset, then we need to take the temporary difference and split that between how much relates to what will be taxable and how much will be non-taxable. In our case, the 80 temporary difference will only be taxable to the extent of 30, because any proceeds in excess of the original cost are not taxable. Therefore, the revalued amount of 150, a portion of it is essentially tax-free. So we will only recognize deferred tax on the taxable portion of the temporary difference, which is the 30, and then the 50 is tax-free, and so there's no deferred tax on that. In essence, we will then have a total deferred tax balance, also recognized in other comprehensive income, of 9 if the intention is to sell the asset. So you can see that the outcome from the assessment is can result in quite a large difference between whether the asset is sold or used, and so it's very important that the entity considers this on a case-by-case basis for its various assets. A couple of final points on measurement. Firstly, deferred tax assets and liabilities are never discounted. Even if the settlement or reversal of the deferred tax happens at some point in the distant future, we ignore time value of money. IAS 12 is quite specific. We do not discount deferred tax balances ever. Just to repeat again, any deferred tax assets are only recognized to the extent that it is probable that there will be future taxable profits available against which to utilize it. On that point, if an entity has recognized a deferred tax asset and has incurred losses in either the current or preceding period, IAS 12 requires the nature of the evidence to support the recognition of the deferred tax asset to be disclosed. And in terms of presentation, all deferred tax balances must be classified as non-current. It may be that a deferred tax balance is expected to reverse in the next 12 months, but the deferred tax balance in its entirety is classified as non-current regardless of the timing of reversal or recognition of the balances. Still on the topic of presentation and disclosure, an entity must offset current tax assets and current tax liabilities if it has a legally enforceable right to set off the recognized amounts, and it intends to either settle these amounts on a net basis or realize the asset and settle the liability simultaneously. In group accounts, you would only offset current tax assets of one entity and current tax liabilities of another entity if there's a legal right of set-off and the entity is able to make or receive a single net payment and has the intention to do so. Most jurisdictions see each entity as a separate taxpayer, and so unless there's something to the contrary, one would keep the tax balances of the different entities separate, but aggregate the amounts. So aggregated tax liabilities and aggregated tax assets for the respective entities. From the deferred tax perspective, these balances would only be offset if the entity has a legally enforceable right to set off current taxes, and the deferred tax assets and deferred tax liabilities relate to income taxes levied by the same tax authority on either the same taxable entity or once again on different taxable entities where there's an intention to settle net, where that is in fact permissible. For disclosure purposes, entities are also required to disclose a tax reconciliation showing how the effective tax rate relates to the statutory tax rate for that particular jurisdiction. This can either be done numerically or by virtue of adjusting the tax rate to get to the effective tax rate. Either of the two methods is permissible. And so, for example, one would then show in the reconciliation the effects of, for example, non-deductible expenses, non-taxable income, any adjustments arising from changes in tax rates in respect of deferred tax balances from previous periods, and any other adjustments that have an impact on the effective tax rate. In addition, bearing in mind the restriction on the recognition of deferred tax assets, an entity must also disclose the extent of any unrecognized deferred tax assets in respect of assessed losses, unused tax credits, any other deductible temporary differences which were not recognized as deferred tax assets by virtue of the fact that it was not probable that there would be sufficient taxable profits against which these could be utilized. So that brings us to the January 2016 amendments to IAS 12, which amended some of the principles around the recognition of deferred tax balances, with some focus on the recognition of deferred tax assets and the explanation around the restrictions relating to future taxable profits. To put the amendments into context, consider the following scenario. A company purchases a debt instrument for $1,000 in 2017, which has a maturity of 10 years and pays 2% per annum at the end of each year. They elect to account for it as an available for sale financial asset under IAS 39. Now, for those that aren't familiar with it or perhaps have forgotten, available for sale financial assets under IAS 39 are measured at fair value, with changes in fair value recognized in other comprehensive income. In 2018, interest rates climbed to 5% and the fair value of the instrument falls to $900. It is still probable, however, that the company will collect all of the contractual cash flows. Tax gains or losses are only realized when the instrument is realized. Is there a temporary difference here? Let's go back to the basics. We have a carrying amount of $900. What is the tax base? Remember, the tax base of the instrument, of the asset, is the amount of future deductions that are available to the entity when it recovers the carrying amount of the asset. If the entity collects $1,000, which is what they're expecting to do, what would the tax authorities allow as a deduction against the $1,000 that's been collected? It would basically be the full original face value or carrying amount of the instrument. Even though the carrying amount has reduced to $900, the tax base remains $1,000. The tax authorities are not going to change what will be deducted for tax purposes upon collection of the money. So if they collect $1,500, for example, if they were to sell it for $1,500, they would presumably, the entity would presumably have to pay tax on the $500 difference. In this case, because the carrying value is less than the $1,000, there is still nonetheless a temporary difference which has to be accounted for deferred tax purposes. So what's changed as a result of the amendments? There were basically 3 amendments to IAS 12, and each one dealt with a slightly different aspect relating to the principles that we've already discussed. The amendments were issued to clarify the recognition of deferred tax assets for unrealized losses relating to debt instruments at fair value. That's what prompted the discussion. And although the amendments refer to debt instruments, the amendments are not specific to debt instruments. In other words, the principles that have changed are applicable to any deferred tax computation to the extent relevant. The first amendment says, if the tax law only allows a deductible temporary difference to be deducted from profits of a particular type, that has to be taken into account when considering the availability of future profits. Remember, we said you can only recognize a deferred tax asset if you believe that there will be future taxable profits against which you can utilize that deductible temporary difference. However, if you can only offset capital losses against capital gains, you can't consider the availability of future capital gains for purposes of calculating deferred tax assets relating to operating profits. So the amendment clarifies that you need to assess all temporary differences of the same type in aggregate. The second amendment clarifies that future taxable profit that is used to support the recovery of deferred tax assets should exclude the effect of the deduction representing the reversal of the deductible temporary difference. Failing to do so would effectively result in double counting. So for example, if you had a deductible temporary difference of 100 this year, and we're looking at the profits 5 years ahead to determine if you could raise the deferred tax asset, you would exclude the 100 from that assessment. The third amendment explains that probable future profits may include the recovery of the asset at more than the balance sheet carrying value, even if that value is fair value. Referring back to our previous example, if an entity had an available for sale debt security at fair value of 900, but they expect to collect 1,000, it could use the contractual cash flows from the debt security as the basis for measuring future profits. This has the effect of saying that unrealized losses can be assumed to reverse. In other words, if the value of the security will be pulled to par as the maturity of the security approaches. Again, I repeat, this amendment refers to fixed rates debt instruments for purposes of the example, but please understand that this is not limited to debt securities only. The three amendments which we've just discussed are all effective for periods beginning on or after 1st of January 2017. Early adoption of the amendments is permitted, but upon adoption, the entity will have to apply the amendments retrospectively. That concludes our webinar on IAS 12. If you have any questions, please submit them and we will respond in due course. Thank you very much. Until next time, take care.